You've relaunched your bridging product range with new features and risk appetite. What are, in your words, the key USPs, and why did you decide to bring this refreshed offering to market?
Sure. So the key driver behind our relaunched product range is really better defined product categorization. What that enables us to do, or will enable us to do now, is better tailor the pricing, the loan to values, and the features we're able to offer to reflect the different facility types and the different risks that are associated with it. The feedback we always get, rightly so, is give us maximum clarity. This is from brokers and from the broker market. And so what we're trying to do is provide as much clarity on appetite and criteria and pricing as we possibly can. I know that's been one of the muddled messages of this year, which has been everyone on the surface saying we're open for business, but no one really knowing what that means. And so our new range splits our residential offering into different product types. So we've got development exits and development finishing exits. We've got refurbishment bridges, and that's alongside what would be the more typical and traditional bridges around purchase bridge or a rebridge. And if we take a step back, because it's been quite a year, thinking back to January, February time, there was actually a pretty significant move in the specialist market right at the start of the year in terms of, I guess, pricing pressure and also competition. And then clearly March came and COVID hit, and lenders pulled out of the market or tightened criteria pretty much across the whole spectrum of products. And then clearly CBILS came along. And for us at Ultimate Finance, CBILS has really taken up a lot of our attention, and that's across all of our products as well as bridging. But this is, I think, I've said this before, but I do believe now this is coming to an end. And so it's very important that we come back to market with a revamped offer. And that's really what this is all about this week. I mean, from our side in March, what we did was we tightened our criteria. We reduced our maximum loan to values, and we focused just on the residential space pretty much. But in doing so, it made us realise we were losing a little bit of what made our offer so strong previously. And so we've taken a lot of soundings from the market, from our broker partners, and designed this relaunched product range with that feedback in mind, but also to reflect our view, and we had to take a view on this, on economic conditions and where the market is generally. And as you mentioned, the key feature that we're including within our finish and exit and our refurbishment products is an equity release offering. So where we lend on day one against current value, where there'll be some finishing works, what we'll be able to do now is essentially refinance a portion of the completion cost that would be incurred by the client, and we'll provide the capital for them to release some equity from the project and essentially move that liquidity onto the next project. So this would be capital that would otherwise be tied up for the duration of the term. So we do think there'll be good demand for this. We think that it's solving a problem that is in the market, and there isn't too many other people that offer something similar. So really, that's everything. Our relaunch is just trying to maximise our clarity in the market, and a key part of that, which we know, but we keep having to remind ourselves, is that part of defining and providing clarity is actually articulating what we won't do, and that, as much as anything, has dictated some of our features and our offering.